Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about First Pacific Company Limited Annual Report. First Pacific Company Limited is a diversified conglomerate with a wide range of businesses and services across various sectors. The company's portfolio includes telecommunications and digital services, such as fiber optic backbone, fixed line, and cellular networks. It also has a significant presence in the consumer food products industry, manufacturing and distributing a variety of branded products like noodles, dairy, snack foods, and beverages. In addition to these core businesses, First Pacific Company Limited is involved in agribusiness activities, including seed breeding, oil palm cultivation, milling, cooking oils, margarine, and shortening. The company also explores for mines and produces gold, copper, and silver deposits, indicating its presence in the natural resources sector. Furthermore, First Pacific Company Limited has a significant infrastructure portfolio, which includes the operation of gas-fired power plants, provision of water distribution, sewerage and sanitation services, as well as healthcare solutions. The company also operates toll roads and light rails, and distributes electricity to various regions. With its diverse range of businesses and services, First Pacific Company Limited is a major player in several sectors across Asia and internationally. First Pacific Company Limited market capitalization of $24 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that First Pacific Company Limited holds a significant advantage in their industry. First Pacific Company Limited trades at a lower price-to-earnings ratio of 4 times and a lower price-to-book ratio of 0.7 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company is worthy of investment, or could it be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 4.95%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. On one hand, market expansion has been a significant driver of revenue growth for certain companies and industries. This is evident in the substantial growth experienced by consumer food products in Indonesia, Philippines, and Singapore. Infrastructure development has also contributed to revenue growth, particularly in the Middle East and Africa and Indonesia. Concession agreements have provided exclusive rights and concession fees, generating revenue for companies such as NLEX Corporation. Toll rate adjustments have also led to increased revenue for various roads in the Philippines. On the other hand, industry decline or competition has resulted in significant declines in revenue, as seen in the telecom communications sector in 2024. Concession period expiry and tariff disputes have also impacted revenue negatively, as observed in CAVITEX and Maynilad Water Services respectively. Exchange rate fluctuations, commodity price risks, and fuel price fluctuations have further affected revenue for companies operating in multiple currencies or involved in specific industries such as consumer food products and power businesses. Net income and profit margins experienced significant fluctuations over the years. Initially, net income saw a notable increase of 11.3% from $1,603.3 million to $1,780.9 million on page 4. However, this trend was short-lived as it decreased by $2 million from $1,746.5 million to $1,748.3 million on page 5. A significant turnaround occurred on page 16, where net income rose by 24% to $47.5 million due to a lower net foreign exchange loss. The EBIT margin of Bogasari increased to 9.1% from 8.4%, while agribusiness saw its EBIT margin decrease to 19.6% from 23%. The following years witnessed varying trends, with consolidated core net income experiencing a 1% increase to $601.1 million on page 21, and a 15% rise to $556.8 million on page 26. However, reported net income saw a decline of 7% to $520.8 million on the same page. Notable increases in net income were observed on pages 28 and 29, with a 6% increase to $8.6 billion and a 52% rise to $291.6 million, respectively. Conversely, page 89 reported a significant decrease of $4,054.3 million from $4,396.5 million to $342.2 million. Profit margins also underwent changes, with gross profit margin increasing by 0.6% to 36.8% on page 103, and recurring return on average net assets rising by 1.25% to 15.16%. However, operating profit margin decreased by 0.4% to 21.9% on the same page. The fluctuations in net income and profit margins can be attributed to various factors such as changes in foreign exchange rates, shifts in market trends, and adjustments in business strategies. The company's financial performance is a notable aspect of its overall health. A review of the operating cash flow summary reveals a consistent trend of generating positive cash flow over the past few years. In 2025 and 2024, the company reported operating cash flows of $1,748.3 million and $1,746.5 million, respectively. This steady stream of positive cash flow is a significant indicator of the company's financial stability and ability to meet its obligations. The fact that all years show positive operating cash flow suggests that the company has been able to manage its expenses effectively and generate sufficient revenue to cover its costs. Overall, this trend bodes well for the company's future prospects and provides confidence in its ability to continue generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. Total debt has risen from $12,536.3 million in 2024 to $13,014.1 million in 2025, a modest increase of 4.2%. Long-term borrowings have also increased by 4.6% during this period. However, it's worth noting that the company's net debt has decreased slightly from $9,098.5 million to $8,737.7 million. In terms of interest expenses, finance costs have seen a notable increase of 17.8%, rising from $607.4 million in 2024 to $713.2 million in 2025. Interest expenses on bank borrowings and other loans have also increased by 12.9% over the same period. These increases suggest that the company is paying more for its debt, which may be a concern for investors. Overall, while the company's net debt has decreased slightly, its total debt level and interest expenses have both risen significantly over the past year. This trend suggests that the company may need to reassess its financial strategy to manage its debt levels effectively. The company's performance can be divided into two categories: well-performing and poorly performing segments or regions. In the well-performing category, several divisions stood out for their impressive growth. The agribusiness group saw a significant increase in sales of 32%, with its plantations division contributing to this success with a 21% rise in sales. Bogasari also reported a modest but notable 2% sales increase. In the telecommunications sector, wireless consumer experienced sustained growth in wireless data service revenues, while home achieved record high fiber broadband services and a 6% increase in fiber revenues. Enterprise saw a 3% growth in corporate data and ICT businesses, and digital finance reported its first full year of profit. The company's consumer-facing divisions also performed well, with consumer food products generating recurring profits of $342.2 million and natural resources achieving recurring profits of $343.2 million. On the other hand, some segments struggled to meet expectations. The telco core net income declined by 3%, indicating a setback in this area. Furthermore, the company's head office incurred a recurring loss of $97.9 million, highlighting an area that requires improvement. The management is optimistic about the company's outlook, highlighting several key initiatives aimed at driving growth. One notable area of investment is in infrastructure, with a significant allocation of $1.108 billion towards non-current assets. This strategic move is expected to yield long-term benefits and support the company's expansion plans. In addition to infrastructure development, the company is also focusing on growth through acquisitions, particularly in the health technology sector. The recent listing of Maynilad on the stock market via an IPO demonstrates the company's commitment to exploring new opportunities for its subsidiaries. Furthermore, the management has emphasized the importance of sustainability, with a focus on delivering reliable and sustainable electricity through solar energy projects. However, despite these positive developments, the report also highlights several risks and uncertainties that may impact the company's performance. Exchange rate fluctuations, securities price risk, commodity price risk, and fuel swap contracts for the power business are some of the key concerns mentioned in the report. The management is aware of these challenges and is taking steps to mitigate their potential impact. Overall, while there are some indications of the company's growth strategies and focus areas, the report also underscores the need for careful risk management and strategic planning to navigate the complexities of the business environment. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has expanded its interests through various business combinations and investments. Notably, it acquired intangible assets, service concession assets, and stakes in companies such as STA, Barbara I. Ore Deposit, Meralco, SBNEC, JTT, and JJC. The company also made significant investments in other companies, including Filex, MPIC, and MGen. For instance, MGen acquired a 50.5% voting interest in SBNEC in December 2023, increasing its voting interests to 53.7% by January 2024, and further to 69.3% by October 2025. On the other hand, the company has also made divestitures, including the sale of MPH to become an associated company, resulting in a loss of control. Additionally, it sold a 34.9% interest in Metro Pacific Light Rail Corporation, MPLRC, to Sumitomo Corporation on May 28, 2020. The company's acquisition and divestiture activities reflect its strategic efforts to expand its interests and optimize its portfolio. These transactions demonstrate the company's ability to adapt to changing market conditions and pursue opportunities for growth and development. The company has a history of paying dividends to its shareholders, as evident from various references in the extracted summaries. On page 11, it is explicitly stated that the company pays dividends, and this is further reinforced by other pages such as 13, 22, 24, 32, 36, and 120. These references provide specific details about the amount of dividends paid, including $661 million in distribution to shareholders on page 13, and a total dividend payout of 94 pesos, $60, per share for 2025 on page 22. Additionally, page 32 mentions that the company has paid dividends worth $280 million SGD, $214.4 million USD. However, there is no clear information provided about share buybacks throughout the summaries, leaving this aspect of the company's financial activities unclear. Concerns about inventory buildup and supply chain disruption have been raised in various sections of a report. On page 13, higher sales volumes of noodles from Indofood and increased CPO prices and revenues suggest potential strain on the company's supply chain. Additionally, on page 140, nil revenue related to carried-forward contract liabilities for sale of electricity in 2025 indicates possible inventory buildup or supply chain issues. Further evidence of these concerns can be seen on page 171, where raw materials and finished goods inventories have increased significantly, accompanied by write-downs of inventories to net realizable value. This suggests that the company may be struggling with managing its inventory levels effectively. Moreover, on page 200, sales to affiliated companies and purchases from a joint venture have decreased, which could indicate supply chain disruptions. However, it's worth noting that overall financial performance indicators do not suggest significant issues with inventory buildup or supply chain disruption. Despite these concerns, the company appears to be managing its finances effectively, as indicated by positive net cash flows from operating activities, distribution cover, and current ratio on page 4. That concludes the financial summary for First Pacific Company Limited. Feel free to comment below, and I will be happy to answer them when possible.